Hello, this is Jeremy North with your educational and economic update for March 2021. Well, in this month's video, I'll discuss major headlines that influence markets in February of 2021. As always, please stay tuned at the end of this video for the super exciting required disclosure statement. Well, the end of February saw the stocks and bond markets both pulling back at the same time. While this is a bit unusual, it does happen occasionally. The big moves have come mostly in the tech sector, as evidenced by more than a 20% drop in the giant tech fund, ARK Innovation ETF, which is ARKK. ARKK is concentrated in some of the biggest tech names like Tesla, Square, Roku, which have all had huge gains during the pandemic, but have since dropped around 20% since in the month of February. However, this appears to just be noise in terms of long-term trends, according to at least Think Better market guru Ron Piccinelli. He believes that the recent pullback in tech is no time to panic, as many other indicators remain very bullish, such as the Fed committing to stimulating the economy until inflation gets above specified rates. In his view, the market will continue to be propped up by the infusion of money into the economy that lower short-term interest rates provide. So for February, the S&P was up 2.7%, leaving it up approximately 1.7% for the year. The tech-heavy NASDAQ, though, was down 0.5% after being up almost 7.5% earlier in the month of February. While the Federal Reserve has kept short-term rates historically low, the 10-year bond rates have jumped the most since 2016, which dampens the longer-term bond prices. This has resulted in a pullback for the aggregate bond index, the HEG, of approximately 2.5%, after a total return last year of approximately 7.42%. Since 1981, we have been in a long-term downward interest rate trend, as many people are aware. However, even during this time, there have been many instances of rising rate periods. Since 2006, there have been 10 periods with rising interest rates. Therefore, even though we expect interest rates to trend higher, a continued disciplined approach to proper asset allocation continues to be key. Reacting to worries that reopening the economy will create higher inflation, Federal Reserve Chairman Jerome Powell was quoted at the Wall Street Journal Job Summit that the economic reopening could create some upward pressures on prices. Powell reiterated that the central bank would be patient before changing policy, even as it sees inflation pick up. So in summary, even with optimism around the lower COVID infection numbers, continued federal stimulus, along with growing concerns about inflation, have all worked to push intermediate and longer-term bond returns lower and resulted in a pullback in stocks for February. However, this noise, as we want to call it, in the bond markets, while temporarily halting the stock market's bullish moves, does not indicate a longer-term trend, and most analysts feel the continued improvement in the economy should prolong this bull market. While we remain positive, it is always prudent to be cautious. We continue to evolve our models and strategies, including managers and funds that aim to limit downside risk. If you have any questions about how the recent economic report could impact your long-term goals, give me a call or email. I'm always happy to discuss. Please remember that nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 636-896-4052 or 844-436-0472. With all that being said, here's the super exciting disclosure that I'm required to read. While we believe the information in this report is reliable, we cannot guarantee its accuracy. Opinions expressed are subject to change without notice and are not intended as investment advice or solicitation for the purchase or sale of any security. Please consult your financial professional before making any investment decisions. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining markets. The indices mentioned are unmanaged and cannot be invested into directly. Past performance does not guarantee future results. Thanks again, Jeremy North signing off, and I will see you next month. Take care. Bye.